You asked, and we listened. So today we are going to unpack one of the most seismic events in modern history, the 2008 global financial crisis. We'll explore how a giant like Lehman Brothers could simply vanish overnight, what domino effect that triggered across the world, and most importantly, what powerful lessons it holds for us as we navigate the economy of today and look towards 2025. And you'll definitely want to stick around until the end, because I'll be sharing 3 timeless investing rules drawn directly from the ashes of 2008 that can help safeguard your wealth against the next big storm. Ready? Let's dive in. Picture this. It's the mid-2000s. The housing market is on fire. It feels like everyone is buying a home, flipping properties, and getting rich. The mantra was, house prices only go up. This seemingly endless boom was fueled by something called subprime mortgages. Now, what are those? Simply put, they were loans given to borrowers with poor credit history, people who, under normal circumstances, might not have qualified for a mortgage. Banks weren't too worried, though. They believed that even if a few people defaulted, rising home values would cover any losses. But here's where it gets complicated. The banks didn't just hold on to these risky loans. They bundled thousands of them together into complex financial products called mortgage-backed securities and collateralized debt obligations, or CDOs. They then got credit rating agencies to stamp these bundles with a AAA rating, the safest investment grade possible. It was like taking a bunch of rotten apples, hiding them inside a shiny box, and getting an expert to declare the whole box as perfectly fresh. These secure investments were then sold off to pension funds, other banks, and investors all over the world who were hungry for high returns. The system was generating massive profits, Wall Street was booming, and the bonuses were flowing. The party, it seemed, would never end. But beneath the surface, the foundation was cracking. By 2007, the music started to slow down. Interest rates on many of those subprime mortgages began to reset to much higher levels. Suddenly, homeowners who were barely making payments found themselves unable to cope. Defaults started to skyrocket. People began to realize those safe mortgage-backed securities were actually filled with toxic, worthless debt. The panic began to set in. The tipping point came in September 2008. Lehman Brothers, a 158-year-old titan of Wall Street with over $600 billion in assets, was drowning in these toxic assets. It had leveraged itself to the hilt, betting heavily on the housing market. When the government refused to orchestrate a bailout, the unthinkable happened. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was, and still is, the largest bankruptcy filing in U.S. history. The fall of Lehman was not just one company failing. It was a cardiac arrest for the entire global financial system. Imagine a web where every bank and financial institution is connected. Lehman's collapse severed a massive chunk of that web, sending a wave of pure panic through the markets. No one knew who was exposed. Banks stopped trusting each other and froze lending overnight. This credit freeze is the lifeblood of the economy. Without it, businesses can't get loans to make payroll, and consumers can't get credit for cars or homes. The entire economic engine seized up. Within weeks, the Dow Jones Industrial Average plummeted. Stock markets around the world crashed by over 30%. The contagion spread from Wall Street to Main Street. Millions of people lost their jobs. Families who had their life savings in the stock market saw it evaporate. Foreclosure signs popped up on lawns across the country as people lost their homes. The American dream turned into a global nightmare. Faced with a complete meltdown, governments were forced to act. In the United States, the government passed the $700 billion Troubled Asset Relief Program, or TARP, to bail out the too-big-to-fail banks. It was a hugely controversial move. On one hand, it likely prevented a full-blown second Great Depression. On the other, it felt like the very people who caused the crisis were being rewarded with taxpayer money, while ordinary citizens paid the price. This bailout sparked immense public outrage and sowed a deep-seated distrust in financial institutions and government that still lingers today. So, how did we get there? What were the root causes? It really boils down to 3 core factors. First, and perhaps most obviously, was pure, unadulterated greed. The financial industry became obsessed with short-term profits. Banks and mortgage brokers were incentivized to issue as many loans as possible, regardless of quality, because they could package them up and sell them off, passing the risk to someone else. The bonus culture on Wall Street encouraged reckless risk-taking. The second major cause was a massive overload of debt, or what financiers call leverage. Everyone was over-leveraged. Home buyers took on mortgages they couldn't afford. Banks were borrowing huge sums of money, sometimes 30 or 40 times their actual capital, to bet on these risky securities. When the value of those assets collapsed, they were wiped out. Does this sound familiar? Today, we're looking at a global debt pile of over $300 trillion. It's a stark reminder that excessive debt makes the entire system incredibly fragile. And the third critical failure was weak and fragmented regulation. The rules simply hadn't kept up with the financial innovations. There were huge blind spots in the system. Regulators either didn't see the risk building up or lacked the power and political will to stop it. They allowed these complex, opaque financial products to spread throughout the system like a virus, with almost no oversight. It was a catastrophic failure to manage risk on a systemic level. The big question now is, are we any safer? Well, yes and no. The crisis did lead to significant reforms, like the Dodd-Frank Act in the U.S., which aimed to increase bank capital requirements and create more oversight. Banks are generally better capitalized now than they were in 2008. However, new risks have emerged. The rise of shadow banking, new complex derivatives, and record levels of corporate and government debt mean the system is far from risk-free. History has a funny way of rhyming, if not repeating itself. This brings us to the most important part of this video. What can you, the common investor, learn from this monumental collapse to protect and grow your own wealth? Here are 3 powerful lessons from the 2008 crisis. Lesson number 1 is the golden rule of investing. Diversify, diversify, diversify. In the run-up to 2008, so many people were over-concentrated in one asset class, real estate. They believed their house was a golden ticket. When that single market collapsed, they lost everything. A truly diversified portfolio spreads your risk across different non-correlated assets, like stocks, bonds, real estate, and maybe even commodities or alternative investments. If one sector takes a hit, the others can help cushion the blow. Don't put all your eggs in one basket. Lesson number 2, avoid the siren song of debt. The 2008 crisis was, at its heart, a debt crisis. It crushed borrowers who took on high-interest, adjustable-rate mortgages they couldn't possibly afford. The lesson for us is simple but profound. Live within your means and be incredibly wary of debt. Avoid high-interest credit card debt like the plague. If you take out a loan for a house or a car, make sure you understand the terms completely and that you can comfortably afford the payments even if your circumstances change. Debt can be a tool, but it can also be a trap that destroys financial freedom. And lesson number 3, stay informed and be a student of history. One of the most famous quotes in finance is, "Those who do not learn history are doomed to repeat it." The patterns of bubbles, greed, and fear have repeated throughout financial history for centuries. By understanding what happened in 2008, or during the dot-com bubble, or even the Great Depression, you can learn to recognize the warning signs of market euphoria and systemic risk. Don't just follow the herd. Read, learn, and develop a healthy sense of skepticism. This knowledge is your best defense against making emotional, panic-driven decisions. The 2008 financial crisis was a painful and costly lesson for the entire world. It showed us how quickly wealth can be destroyed when greed, debt, and lax oversight combine. But by studying its causes and consequences, we can equip ourselves with the wisdom to navigate future uncertainties. If you want more deep dives into financial history and practical tips to build your wealth, make sure you're subscribed to our newsletter. The link is right down in the description below. Thank you so much for watching Common Investors today. I hope you found this breakdown valuable. If you did, please do us a huge favor and hit that like button, subscribe to the channel, and ring that notification bell so you never miss our future lessons from financial history. And if you haven't seen it yet, be sure to check out our quick 60-second recap of the 2008 crash. I'll link it here. Now I want to hear from you. Based on what you've seen, are we overdue for another major crash? What do you think is the biggest risk in the market today? Drop your thoughts in the comments below. I read every single one. Thanks again for joining me, and I'll see you in the next video.